So hello, my name is Brandon Hall, and thank you for attending this webinar this afternoon on which IRA is best for you. I've been with Midland for 12 years now. We've ever since we started the IRA part of our business. Prior to that, we were a CPA firm. By the way, everybody is muted because when we have this many people on a call, we tend to hear a lot of typing and coughing and chatter. So it's just better to mute everybody. And if you have any questions, just type them in the question box or the chat box, and we will get to them either during the presentation or at the end, or possibly if it's more of a one-on-one question, I'll discuss it with you afterwards. So again, my name is Brandon Hall. I'm the Senior Vice President here at Midland. I am a certified IRA service professional, and there's my contact information on the screen. I'm always available to answer any questions you may have. When I was asked to do this presentation today, I thought, wow, what IRA is best for you? It's impossible to answer. I mean, there's multiple types of retirement plans, and some are better suited to some people in their circumstances, and others are better suited for other people. So, you know, hopefully by the time I give you all this information, you could take it and talk with your CPA or financial professional and decide what is best for you. But I think this presentation will be helpful in helping you move in that direction. So let's get started here. Again, if you have any questions, just type them in the chat box and we'll get to them. Midland IRA has been around for 12 years now. As I said, prior to that, we were a CPA firm, which we have sold off in the past. So now we specialize simply in two operations. We're a self-directed IRA administrator. We currently administer over 11,000 accounts, over $1 billion in client assets for IRA accounts. We are also a 1031 exchange accommodator. A certified exchange specialist is on staff. We actually have 2 of them on staff. For those of you who don't know what 1031 exchanges are, I'm not going to get into details because that's not the point of this webinar, but it's a way to defer taxes, capital gain taxes, on the sale of investment property that's personally owned. Personal real estate, as long as you're replacing that property, you're basically selling a property and buying a replacement property, and as long as you follow the rules and buy up in value, equal or up, you can defer all the capital gains. So both of our businesses revolve around deferring taxes. In IRAs, it's built into the way IRAs were created, and then for non-IRAs, they have the section of the tax code called Section 1031, which is specific to real estate. I do want to point out we do not make any commissions because we do not sell any investments here at Midland. We work at the client's direction, and we're just simply a record keeper or administrator. We do all the required IRS reporting for IRA accounts. We collect income from our clients' investments and pay bills associated with those investments if those apply. But we do not advise, sell, or act as a bank and loan money out the back door. So we have a different business model here. Our industry is dominated by stockbrokers and banks, and while I think they do a fine job, they only let you invest in what they sell. So they have a different way to create revenue. They'll do administrative functions for free because they know they're going to generate revenue, in other capacities. We at Midland do not sell any investments or operate as a bank, and so we simply live off of our administrative fees. So any information in this presentation is for educational purposes only. I'm not going to tell you what type of account is best for you, but I hope by going through these slides you'll be able to figure that out for yourself. But we always advise you to consult with attorneys or accountants or financial advisors because they are the professional sources for advice. Before we get into the different types of retirement plans, I do want to talk about the 3 primary advantages of IRAs, and this will be brief, and why people put money in IRAs. The first is the obvious, building for retirement. Unfortunately, 69% of Americans are going to rely on working at least part-time for income in retirement. And it's just a matter of people just not saving enough. If you look at this slide, if you look at the sixth column over, 2015, you'll see that more than a third of retirees in America have less than $1,000 saved up. That's a sad. And you'll see only 19% have $250,000 or more saved up. And this is savings and investments reported by retirees. I do want to point out those last two columns kind of indicate to you how important it is to have a plan, because when you have a retirement plan, you know, in my case, we have a company 401k plan, and you know, part of my salary goes into that 401k, and it's nice because you know, you get used to living off of the paychecks you receive, and if you're not used to receiving the money and it's going into your plan, you know, you don't miss the money as much. And so you can see that 2015, while 19% have $250,000 or more, 30% of those have a retirement plan. And among those who do not have a retirement plan, only 6% have $250,000 or more. So as you can see, the more likely you are to have a plan, the more likely you are to have a good amount of savings and investments built up. The second reason people put money in IRAs is simply the time value of money, which basically says money is worth more now than it will be in the future. So why do you want to pay taxes now if you can defer them to the future? So we'll get into some alternate views of that with the Roth IRA as we progress through this presentation. But that's probably the primary advantage of the IRA, is you get the tax-deferred growth. And here's an example of that. And you may have to pay taxes at the end of the day anyway, depending on the account type. But you can grow that revenue faster in a tax-deferred account, assuming you invest it well. That's always the key. In this example, this client was going to have a total tax burden of $72,000 on this transaction. Had they done this transaction in an IRA or in a 1031 exchange, they would have had $460,000 left to reinvest instead of $388,000. So they've got an additional $72,000 working for them in the next investment. So that just shows you the power of wealth growth within an IRA. The third reason that people put money in IRAs is tax deductions. Now, not all accounts have tax deductions, and we'll talk about that a little bit later. But in a typical example, if you're putting $6,000 in a traditional IRA and you're in the 25% income tax bracket, you know, you're going to get to lower your income by $6,000, and it's going to save you $1,500 in taxes. So, in essence, Uncle Sam's funding part of your retirement savings. Now, you will be taxed in that example because it's a traditional IRA. You will be taxed at the end of the day when you take money out. But while you know you've got a lot of growth potential in between to avoid taxes, or at least defer them. So many of you may be accustomed to the term self-directed IRA. It's kind of a new term. It's been around. It's growing in popularity. It's really a made-up term. There's no such thing as a self-directed IRA in the IRS's eyes. There's four types of IRAs: traditional, Roth, SEP, and simple, and we will talk about each of those. Self-directed is just a descriptive term that indicates that the client is making all of their own financial decisions or investment decisions. You can have a self-directed IRA at Charles Schwab or Fidelity where you're picking out the stocks that you want to buy. It's self-directed. You're making your own decisions. But it's not truly self-directed because Schwab and Fidelity, they won't let you buy any type of asset that they don't sell. They won't let you buy a piece of real estate, for example, or do a hard money loan. Number one, because they don't know how to make any money on it. And number two, because of the administrative burdens of real estate closings and tax bills and deeds and insurance and rent. And they just don't want to, they're just not set up to accommodate that type of investment. So Midland offers, we're a true self-directed plan administrator because we don't limit your choices, and we allow you to buy these what we consider alternative or non-traditional investments. So as I said, there's 4 types of IRAs. You have your traditional, which is the most common, probably makes up roughly 75% of our accounts, maybe 75 to 80%. Typically, if you had an old 401k from an old plan and you retire or terminate your employment, that money gets rolled into a traditional IRA. In more recent years, some of that potentially could go into a Roth, but it's more common for it to go into traditional. Depends on how the contributions were made to the 401k plan. Roth IRAs came out in the 1990s, whereas traditionals came out in 1974. So there's far less money in a Roth IRA, but it does have some big benefits in the way it's taxed, and we're going to talk about that shortly. And Roth IRAs probably make up 15% of our accounts. So we've covered probably 95% of the IRAs that we administer are either traditional or Roth. And really the main difference is when the account gets taxed. Traditional gets taxed at the end of the day. The Roth gets taxed up front and not at the end of the day. Then you have your SEP and simple plans. Those are IRAs that have to have an employer sponsor. So if you don't have an employer that is willing to sponsor a SEP or a simple, then that really doesn't apply to you. A lot of people, though, are self-employed. We have a lot of realtors as clients, due to the fact that they can buy real estate with their IRA, and they know the real estate market better than they do the stock market. So we do have a lot of realtors as clients, and a lot of those realtors have SEP IRAs because they're self-employed, and the contribution limits for them are larger. Now, if you have employees, there's some other items that come into play, and we'll talk about that when we get to the SEP slide. We also see Coverdell educational savings plans, which IRAs are meant to benefit you when you retire. Educational savings plans are meant to benefit you or your children when they have educational expenses. And then HSAs, health savings accounts, those have been out about 7 or 8 years, I believe now, and those are to benefit you when you have health expenses. So we'll talk about each one of those. And then finally, the 401k plan. That's kind of the Cadillac of retirement plans that we offer. It is slightly more expensive because you have to pay for plan documents annually, but it allows for the most flexibility, the most control, the highest contribution limits. But if you're not going to use the benefits that it offers, why pay the extra buck for it? You can do the same investments in an IRA that you can in a 401k. So it is the Cadillac of plans, and for real savvy investors who really want to maximize their tax deferrals, the 401k plan is possibly a good option. So we're going to talk about each one of these as we go through. So let's start with the traditional. It says anyone with earned income qualifies. That doesn't mean you have to have earned income to qualify to have a traditional IRA. It just means you have to have earned income in order to contribute to it. My father, for example, he's retired. His only source of income is Social Security and pension, and neither one of those qualify as earned income. So my father, he could have a traditional IRA, and he does have one, but he cannot contribute to it because he doesn't meet the earned income qualification. Also, his traditional IRA, he could not contribute to it as well because he's over 70.5 years old. So at age 70.5, you actually have to start taking money out of your traditional IRA. The IRS is basically saying, this account has been tax deferred long enough, we want to start seeing some taxes. So they make you take out what's called a required minimum distribution at age 70.5. So again, even if my father had the earned income to qualify on that first point there, he's over 70.5, so he would not qualify on the second point. Distributions can be taken at age 59.5 without penalty. If you take money out of your IRA prior to age 59.5, if it's a traditional IRA, it's going to be subject to taxes plus a 10% penalty for early withdrawal. There are a few exceptions to the penalty. For example, if your child has educational expenses, if you're disabled, if you're a first-time home buyer, you can take out up to $10,000 penalty-free. You're still going to owe the taxes in any of those cases, but you can at least avoid the penalty. And you may have an IRA in addition to a qualified plan. So if you have a 401k at work, you could also have an IRA, and you can contribute to it. But depending on your income and whether you're an active participant in a qualified plan, you may or may not be able to deduct that IRA contribution. But if you keep track of your non-deductible contributions, you can take distributions in the future, and a portion of that will not be taxable because it was a non-deductible contribution. So in other words, you will not be double taxed on those non-deductible contributions if you keep track of them, or your CPA keeps track of them. But you can have an IRA in addition to a qualified plan. Roth IRAs are subject to the same rules as the traditional IRA, except contributions are post-tax and not tax deductible. So when you make contributions to a Roth IRA, you do not get to lower your income. So you're basically paying the taxes up front. But at the end of the day, you'll never be taxed again, assuming you're over 59 and a half, and you've had the account for at least 5 years. There is no minimum distribution required at age 70 and a half. Remember, with the traditional, I said you have to start taking money out at age 70 and a half. With the Roth, you do not. And the reason they make you take it out of the traditional, remember, was they're tired of this account being tax deferred. They want to start seeing some taxes. Well, in the Roth IRA, they're not going to see any taxes anyway because you've already paid them. So they do not make you start taking money out. You can leave it in there until you pass away, and you could, at that point, it would become a Roth IRA for the beneficiaries of your account. And if those beneficiaries were a non-spouse, they would have to start taking money out at that point. But that's a beneficiary distributions and required distributions for beneficiaries is a whole other topic. And if you have questions about that, give me a call or email me, and I'd be happy to talk about that. Roth IRA, there are income requirements to put money in a Roth IRA. In previous years, prior to 2010, there were a lot of doctors, for example, that could not put money in a Roth IRA because their MAGI, which stands for Modified Adjusted Gross Income, was too high. In 2010, they removed that limit for Roth Conversions, which means that all of these wealthier people could do a Roth conversion, which means move money from their traditional IRA into a Roth. They do have to pay taxes on the amount that they move into the Roth, but those limits were removed in 2010, so now anybody can do that. In 2010, we had a lot of doctors doing Roth conversions. They were moving money from their traditional to the Roth, paying the taxes up front, knowing that going forward they'll never owe taxes again, assuming they follow the distribution rules. So in 2016, the current contribution amounts, contribution limits for traditional and Roth is $5,500 a year. If you're over 50, because retirement plans didn't exist in your early working years, they allow you a catch-up of $1,000. So if you're over 50, you can put in $6,500 a year. And that's per year. The deadline is April 15th, so we've already passed the deadline for 2015. So right now we can only accept 2016 contributions. But between January 1st and April 15th of 2017, we'll be able to accept both 2016 contributions and 2017. So during that three-month span, 4-month span, whatever it is, you can contribute to both years, assuming you haven't already in the previous year. As I said, you have to have earned income. I think it's more important to look at what is not earned income in the IRS's eyes. Social Security is not earned income. You could argue that you earned that, but you didn't earn it in the year that you're making the contribution for, so it doesn't count. Investment income, we have a few clients that are that don't have W-2 jobs or commission jobs. They simply own multiple pieces of rental properties, and unfortunately the income that's produced on from those properties is not considered earned income. I suppose they could form a company, they could talk to their CPA and structure, pay self-employment tax and structure it where it could be a business, but that would be a conversation between them and their accountant. Pensions, as I said with my father's example, pensions do not qualify, so taking money out of an IRA is not going to create earned income to put back in an IRA, or taking money out of a pension or 401k. Support payments also are not included. So basically, to make contributions, you've got to have a job, W-2 or commission type job. Again, as a reminder, if you have any questions, write them down or go ahead and type them in the question or chat box, and I'll get to them at the end. So let's talk briefly about the SEP IRA. That probably makes up close to 5% of our accounts. So between the traditional Roth and SEP, that pretty much covers 99.9% of our accounts. The SEP IRA is an employer plan that allows contributions to eligible employees. Each employee does have an individual account, and they may be self-directed. The advantage of a SEP IRA over a traditional is a much higher contribution limit. It's employer sponsored, and the employer can put in up to 25% of income to a max of $53,000. Kind of the downside to a SEP IRA, I suppose, is if that employer has employees, they've got to put in an equal percentage of their salary into their own plan. So if you're self-employed with no employees, like most realtors, you can maximize your contributions because you don't have any other employees to worry about. But if you're a realtor that has somebody that you pay as an employee, if you put in 25% of your income into your SEP IRA, you're required to put in 25% of that employee's income into their SEP IRA. So this is perfect for self-employed individuals with no employees. If you have employees and you don't want to contribute to their plan, then you're better off with the traditional or Roth. And that's because that's an individual retirement plan, not an employer-sponsored plan. So the contribution limit for a SEP IRA is 25% of net income up to $53,000. So it does give you the capability of getting a lot more money into a tax-deferred account, and you'll get a write-off for every penny. You'll get a write-off for the contribution. Unfortunately, though, SEP IRAs do not have Roth components built in, so ultimately you will be taxed at the end of the day when you remove distributions from the SEP IRA. If you did a SEP IRA, let's say you're self-employed and you opened a SEP IRA, and down the road you hired somebody, you could always just cease to make SEP contributions for yourself, and you wouldn't have to make them for your employees. Or you can just transfer it over to a traditional IRA, and then you'd be limited to your $5,500 or $6,500, and you wouldn't have to worry about contributions for the employees. Simple IRAs, I don't want to spend too much time on these because they're so few and far between. I think out of our 11,000 plus IRAs, we have less than a dozen of these. They're typically employer-sponsored plans for companies that have between 50 and 100 employees. They're a little bit cheaper than a full-blown 401k, so they're a little bit more advantageous from that standpoint. But the contribution levels are not quite as high either. But we just see so few of these, typically because employers that have 50 to 100 employees, they probably have a lot of employees that have smaller account balances. Maybe they just started their first retirement plan, and they typically want to give them the ability to invest in traditional stocks and mutual funds, because most of our clients are buying assets like real estate and notes and private placements, and it's very odd for us to have a really small account here. Our clients are typically buying assets that cost 50,000, 100,000, 200,000, and there's just not a lot of options for the smaller accounts. So we don't see a lot of these simple IRAs, but they do exist. So IRAs are considered non-qualified retirement plans. I never like to use that word because I don't like to scare people into thinking that it's something bad because it has non-qualified. It just means that it falls under a different set of rules than qualified plans. In the qualified plan world, you have defined benefit, pension plans. A lot of doctors have those types. 401ks are retirement plans from typically businesses such as our own. 457s are usually government employees. 403bs are usually educational employees, teachers. My wife is a school teacher. She has a 403b plan. Unfortunately, we do not offer any qualified plans with the exception of the individual K plan, the individual 401k plan. And I'll talk about that on the next slide. If you have a 403b or 401k or 457 right now, and you're thinking about self-directing it into let's just say a piece of real estate, the odds are you're probably not going to be able to do so if it's an active plan, because your current employer probably limits where your plan has to reside. My wife, like I said, has a 403b through the school system here in Lee County, Florida, and I would love to move it to Midland so I can be more creative with my investment choices. But until she separates her employment, either quits or gets fired or retires, it's pretty much locked into whatever plan they've set up. And I think they give her a whopping 7 choices of investments. 6 mutual funds or cash, and that's it. Like I said, I would love to move it here, but until she has a triggering event, there's really nothing we can do about it. We do have a few doctors that have small company plans, and they're the trustee of the plan, and they figure out a way to make it work. But typically, if it's a larger organization, you're probably not going to be able to move that money until there's a termination of employment, or at least till you reach an in-service rollover date, which some plans have them at age 60. But you can talk about that with me on an individual basis if you want. So individual K plans, we do offer these, and they're basically self-directed 401k plans for business owners with no employees. Why do we at Midland not offer individual K plans or 401k plans to business owners with employees? Because the minute you have employees, the government wants to step in and make sure that you're not discriminating against those employees. And so there's a whole industry of TPAs, that's third-party administrators, that are in the business of testing plans to make sure that employees are not being discriminated against. And Midland is not in the testing business, nor do we want to be. So we offer individual K plans to self-employed individuals, self-employed business owners who do not have employees, because those do not have to be tested. There's no employees to worry about, so there's no way discrimination is going to take place. An example of discrimination would be a business owner giving John Smith an 8% match while he gives all the other employees a 3% match. If you're going to match John Smith 8%, you've got to match everybody. And so these full-blown 401k plans, if you have employees, I would typically refer you to a third-party administrator elsewhere, and there's lots of them out there. So our individual K plan is only appropriate for owners and or spouses. Spouses do not count. If you have a spouse that's an employee, that's okay. But it is only appropriate for self-employed owners and their spouses. So the biggest benefit, as I said earlier, the 401k is kind of the Cadillac of retirement plans. The biggest benefit is the contribution limits. You can put $18,000 out of salary deferral, up to $18,000. If you're over age 50, you can put an additional $6,000 in, so you can get $24,000 up front out of your salary, and then you can put an additional 25% of salary of self-employment earnings. So you could, between the three types of contributions, the most you can put in if you're under age 50 is $53,000, and the most you can put in if you're under age 50 is $53,000, and if you're over age 50, the most you can get in is $59,000. So you can see it has really high contribution limits. The biggest advantages of 401ks over the IRAs, number one, IRAs have custodians, and the custodian is responsible for buying assets and selling assets. In the 401k world, you don't have a custodian, you have a trustee. And because our plans are for the self-employed, 99.9% of the time, the client is going to appoint themselves as the trustee of the plan. So the trustee of the plan, is the plan administrator, and they have a lot more control. We have what we call a do-your-own plan, where you could go set up a checking account at whatever bank you want and set it up in the name of the plan. And because you're the trustee of the plan, you have the ability to write checks out of that account. Now, you do have to make sure you know the rules and you're not doing anything that's prohibited in the retirement world. But as long as you're, if you're knowledgeable about the rules, you can actually open up a bank account, park your 401k there. You could buy the assets without Midland even being involved. You could buy the piece of real estate or the note, whatever you want to do investment-wise, you could do it on your own because you're the trustee of the plan, so you have checkbook control, and you could sign the closing documents as the trustee. Whereas if you buy assets in an IRA, typically we're the ones signing those documents and we're the ones funding those investments. So you have a little bit more control. Accelerated contributions. What we mean by that is, let's say you're under 50, so the most you can put in a 401k is $53,000. The most you can put in a SEP is $53,000, right? So let's say you made $400,000. It's pretty good for somebody under 50, but let's just say somebody did make $400,000. 25% of that in a SEP, so they could put 25% is $100,000, but the limit is 53, so they can max out their plan at 53,000. With the 401k, they would have the same limit. But let's drop down to somebody who has less income now. Let's say somebody has income of $100,000. Well, in a SEP IRA, you could put in 25%, so $25,000. In the 401k, they can put $18,000 as salary deferral plus 25%, so they can get in $43,000. So for those who make under a certain amount, roughly $220,000, you could get more money in a 401k than you can a SEP IRA simply because of that salary deferral. So in my last example, $100,000 income, you could get an additional $18,000 into your retirement plan and get a tax write-off for that, where you couldn't do that in a SEP IRA. It has the highest contribution limit. We've kind of already discussed that. It also has the ability to make large Roth contributions. Keep in mind the SEP doesn't offer that. So if you have an IRA, the most you can ever put in a Roth is $6,500 if you're over 50, or $5,500 if you're under 50. That's just not very much. With the 401k, the salary deferral contributions can be Roth. So the first 18 or the first 24, depending on your age, can be Roth. Now the 25% after that cannot be. It has to be traditional contributions to the plan. But at least the first 18 or 24 could be Roth. So that's an ability to get a lot of money into a Roth in 1 year. Also with 401ks, loans are available. Now, some people view IRAs as having this capability. They really don't. I know you can take money out of an IRA and put it back within 60 days. You're allowed to do that once per 12 months. And while you may view that as a short-term loan, there really was never a loan document drawn up where you're promising to pay back your IRA. So technically that's not a loan. What that is a distribution followed by a rollover. But in the 401k world, you can actually borrow up to $50,000 or half of the plan value, whichever's lower. So as long as you had at least $100,000 in a 401k, you could borrow up to $50,000 of that. You do have to pay it back over a 5-year window with at least quarterly payments. No, it can't just balloon the interest at the end, but it is something that you know, sometimes people fall in hard times, and it's something that's nice to be able to have because you're paying your plan interest rather than Bank of America. We had a lot of realtors that in 2005 were clients, and down here in Southwest Florida, the real estate market was booming in the early 2000s, and we had a lot of realtors that fell on hard times when the market collapsed, and they transferred their or they rolled over their traditional IRA or their SEP IRA into a 401k solely to give them the ability to borrow money from it. So that is an option. UDFI and UBIT, that stands for unrelated debt financed income and unrelated business income tax. Basically what this means, if an IRA was to take on debt, now we don't see a lot of that. Most of our IRA clients are paying cash for their investments, and if they don't have enough money in their IRA, they're partnering up with a cash partner, whether that be another IRA or another individual or themselves. So typically the deals that we see, the transactions that we process are cash deals. But in the 12 years I've been here, we've probably processed 30 or 40 transactions where the client's retirement plan borrowed money from a bank. Now, it can't be traditional financing, so I don't want to get your hopes up that it always works out. When an IRA or retirement plan takes on debt, the debt has to be non-recourse, which means there's no personal guarantee. Most banks won't do those types of loans, but I do know of banks that will. But when an IRA takes on debt, the IRS doesn't like the idea that the borrowed money is helping the IRA grow faster than it can on its own. So they tax the portion of the revenue that's attributable to the loan. So if your IRA was to borrow money to do a transaction, a portion of that revenue would be subject to unrelated business income tax. But that tax does not apply to 401k plans. So when I'm having a conversation with a client and they're interested in buying an asset that has debt against it, my first question is always, are you self-employed? And the reason being is I'm trying to qualify them to see if they qualify for the individual 401k plan. Because if they do, the extra $300 that they pay in for plan documents is going to be well worth it when you consider they're not going to have unrelated business income tax to pay. So that doesn't apply to 401k plans. So as you can see, there's 6 or 7 large or really good advantages here of a 401k versus an IRA. But again, if you're not in a position to max out your contributions, or if you don't need to borrow money from if you're not in a position to max out your contributions, or you don't need to borrow from your plan, or you don't have debt finances, debt against your IRA, then why pay the extra $300 for the plan documents? It's just, you're paying for something you're not using. So other savings plans. We talked at the beginning about all the different IRAs. ESAs are out there too. The contribution limits, unfortunately, for ESAs is only $2,000 per child per year. But it is another way you can get a tax write-off, and actually you don't get a tax write-off for ESA contributions, but you do get tax-deferred growth within the plan, and it's not taxed at the end of the day if you're using it for qualified educational expenses. And then lastly, I'd like to, and before we get into, I do want to have a whole Roth conversion and Roth talk, and so I have a few slides after this on that, so I hope you stick around. HSAs is the only type of savings plan that has a triple tax advantage. Okay, all of the other types of savings plans that we've discussed here today get taxed at some point. If you have a traditional IRA or a SEP IRA, you're taxed at the end of the day. If you have a Roth IRA, you're taxed up front. An HSA is never taxed if used properly. So basically, you get a tax deduction for your contributions, just as you would with a traditional. You get tax-free growth. So your investments, the capital gains that are, there are no capital gains in an HSA. And then you get tax-free withdrawals, assuming the withdrawals are used for qualified medical expenses. You must have a high deductible insurance plan in place in order to qualify for this, but the contribution limits are down at the bottom there. For a family, it's $67.50. And last year, we have clients that are both users and savers with these HSAs. A saver would be somebody who's contributing, getting the tax write-off, investing the money in whatever they decide, real estate, whatever, and they're saving it up for when they reach an older age and they start having medical bills. And then you have your users, which would be somebody like me. I have 2 children and a wife, and I already contribute to a retirement plan, so I only contribute enough to my HSA to cover my bills. I have to pay those bills anyway, so why not pay them with money that never got taxed? So basically, I only put money in the plan when I have a bill to pay. And so last year, my family had a couple $1,000s in doctor's bills, and we paid all of those out of our HSA. My HSA balance is pretty much zero because I only put in what I need, but I get a big tax deduction at the end of the year because I get a write-off for those contributions. And those are bills I was going to have to pay anyway, so why not pay them with tax-deferred contributions? So that's a pretty cool plan, I think. So real quick, we'll get into Roth versus traditional. I strongly suggest that you talk to your accountant or financial planner about whether or not a Roth is for you. There's a lot of advantages to both traditional and Roth, and I'm not in a position to advise you. In these next few slides, I'm going to point out some factors that I would consider if I was thinking about doing a Roth account or Roth conversion, but by no means is my opinion the one that you should follow. Everybody's in a different tax situation. Everybody's in different tax brackets. Everybody's got different length of time between now and when they retire. So there's a lot of factors that go into this discussion. But Roth IRA gives you tax-deferred growth and tax-free retirement income. So tax-deferred growth, to me, the younger a person is, the longer they have to grow that account. So the younger the person is, to me, the more it makes sense to be a Roth, because if you have 40 years to grow your retirement, it sure would be nice to be able to grow it without any future taxes being owed. Tax-free retirement income, when you take money out of a Roth, it's already been taxed, so you're not going to have to pay taxes again. Contributions past 70.5, I didn't mention that at the beginning, but you can continue to make contributions to a Roth beyond age 70.5 as long as you have earned income. You can't do that with a traditional IRA. Flexibility with distributions, because it's not taxable, you could take out as much as you want from your Roth account, assuming you're age 59.5 and you've had the account 5 years, but you could take large amounts out and it's not going to change your tax bracket. And then finally, increase net income upon retirement. I always use a client of ours as an example. She's elderly and she has a condo on Fort Myers Beach that's owned by her IRA. And every month we get a check for $1,500 for rent on her condo. And every month she has a recurring distribution set up where we send her $1,500 after that check clears. And so she's living off of the rent that property is creating. And since it's owned by a Roth IRA, she's not being taxed on that at all. So basically she's receiving Social Security and $1,500 rent every month. And because she structured this through a Roth IRA, she's owing no taxes. So that's a prime example. Plus, she's not touching the principal of the investment, which is the condo itself. And her plan is to leave that investment to her children or grandchildren through her beneficiary designation she's established with Midland IRA. As far as conversions, anybody can convert with the exception of non-spouse beneficiaries. So if my father had passed away and left me his IRA, and let's say it was a traditional IRA at the time that he deceased, I would not be able to convert his account, the account that I inherited from him, to a Roth IRA. So I could convert my own account. I could have two separate accounts. I could have my beneficiary account that my dad left me, and I could have my own IRA. I can convert mine to a Roth, but I'd have to leave my father's as a traditional and start taking distributions as such. What types of IRAs can be converted? Any type of tax-deferred IRA, SEP, simple, traditional. Any of the three can be converted. There is one caveat: if you have a simple IRA, you have to have it for 24 months before converting. But as I said, those are not very common accounts anyway. And let's go on here. So before I mentioned considerations before conversion, so here's some that come to mind for me if I was trying to make the decision. And again, I would suggest you talk to your CPA. If you're going to do a Roth conversion, you're going to have to pay taxes. So are you going to have the income to pay the taxes? And keep in mind, if you want to take a little bit out of your IRA as a distribution to help pay those taxes, the amount that you distribute to help pay those taxes is also going to be taxable. So keep that in mind. It could be subject to an early distribution if you're under age 59 and a half. Also, your tax bracket now versus your tax bracket in retirement. For example, my father was an elementary school principal. Let's say 2 years before he retired, he said, "Brandon, I'm thinking about converting." I might say to him, "Dad, why do you want to pay taxes now? Why do you want to convert now and pay, the 28% capital gains rate when you can take distributions in a couple of years at 15% because your income will be down?" So you have to factor things like that in. Also, investment appreciation. That's always the crystal ball question. But what if my dad wanted to buy Apple stock at the right time? Well, maybe he would have been better off paying the 28% now instead of the 15% later, because the investment did so well. But again, that's something that investment appreciation is always a question. It's just you kind of hope you know what you're doing. What impact will the increased income have on my federal tax return? I put income in quotes because when you do a Roth conversion, you're not actually touching the money. It's moving from a traditional IRA into a Roth IRA, but it's considered income. So you're not touching the money, yet it's reported as income. So if you converted a large amount, let's say converted $200,000, that could bump you into the highest tax bracket. So you have to factor that in. So again, I would talk with your CPA about your tax situation, your income, when you're going to retire, what kind of losses do you have that will offset the taxes that are going to be owed. Some years clients have losses and other years they don't, and so those years with losses might be better years for them to do a conversion. So anyway, those are some points I wanted to make on Roth. We're basically coming to the end of the presentation here, and I'll make sure everybody gets a copy of the PowerPoint. But what retirement plan is best? It's impossible for me to answer. There's so many situations that people are in. So this slide kind of gives you a breakdown of the contributions, and again, I'll make sure you all have a copy of this. It tells you when the contributions are taxed, when the withdrawals are taxed, whether or not it accepts rollovers, and all of these plans do, and who it's typically best for. I would say if you have the ability to be part of an employer-sponsored plan, that's your best option. Why is that? Because employers typically match. So if you're not going to participate in your employer plan, you're losing out on those matching contributions. Yes, you could put money in an IRA, but you're not going to get the match from the employer, so you're passing up free money. So if you have an employer plan to be part of, that's to me the best option. and whether or not you want to participate in that plan as a Roth or a traditional, that's entirely up to you. I personally am 42, so my employer offers a plan, and I put in a percentage of my salary, and I put my share into my Roth. My employer matches a certain percentage, and they put that into the non-Roth portion of the plan. But if you don't have an employer that offers a plan, then you can always open an individual retirement account, which would either be your traditional IRA or your Roth IRA. And again, if you're self-employed, you could consider the SEP IRA or the individual K plan. The individual K plan is a little bit better, but again, you have to pay for plan documents, so depending on whether or not you're going to use the provisions that it offers, probably help determine whether or not you go with a SEP or an individual K. So I'm going to get Brenda on the call here. She's going to help me pull up the questions, and we'll see if we can answer them. And some of the questions I might, if they're more of an individual level, I might get back to you individually. But let me unmute. Brenda, I'm going to unmute you right now.
Okay. Can everybody hear me?
I can, yes.
You can hear me. Okay. All right. So we just have a few questions here. I was trying to answer them as Brandon was speaking. For the first question, can a self-employed individual set up a 401k for himself or herself instead of a SEP?
Absolutely, yeah. And again, if you want to maximize the provisions that the plan offers, that's a better option than the SEP. Absolutely.
Okay. Second question is a little bit longer here. I'm going to break it into parts. Can you sell short or buy long futures on a self-directed Roth or traditional IRA?
You cannot. The IRA rules limit. There's several rules, and I'll just briefly discuss the rules just so everybody knows. But basically, IRAs, number one, cannot invest in collectibles or life insurance. So now that that's settleable, I've probably had that question come up maybe 3 times in 12 years, that somebody who wanted to buy collectibles or life insurance. The other rules are the IRA cannot invest in an entity or an asset that's going to provide an immediate benefit. So buying a piece of real estate is allowed, but it can't be for personal use. It's got to be strictly investment. And if you're going to rent it to anybody, it needs to be rented to an unrelated party. And then finally, the IRS does not allow an extension of credit, which in the futures Forex industry, margins and trading on margins and things like that, they require a personal guarantee, which is not allowed by the IRS. So shorting and trading on margins is not going to work in an IRA account, simply because you're technically providing an extension of credit if a margin call were to occur and the IRA was not going to have enough.
Okay. Also going off that question, he asked if there's limits as to how many contracts you could trade at a time.
No, if there were any limits, it would not be at the plan level. It would be at the trading company level.
Okay. All right. If that person has any more questions about that topic, Brandon can answer that afterwards. All right. Our next question is, how do you get to the $59,000? I believe he's talking about when you were talking about the advantages of a 401k, that slide.
Yeah, basically, to get to 59, you would, and we may have already covered this. He may have wrote the question prior to covering it, but to get to 59, first off, you have to be at least 50 years old. So your first $24,000 would be salary deferral, and then you could put in another 25%, and the combined between the three could not be more than 59. So let's assume, we'll do the math here. Let's assume you put 24 out of salary deferral. That means 35 has to come from your employer contributions, and they're limited to 25%. So 35 times 4, you'd have to make at least $140,000 to put in the full 59,000.
Okay, thank you. And our last question, once you start taking money out of your Roth IRA, do you have to continue doing that on some sort of schedule?
You do not, no. There is a provision called a 72T. It doesn't apply to Roths, but if you wanted to take money out of a traditional IRA and you're under age 59 and a half, there is a 72T program where you can start taking money out, and assuming you follow every year and continue to take it out, you don't have to pay the early withdrawal. But as far as the question, it mentioned specifically Roths, so Roths are not taxable. So no, once you start taking out, you could take out as much or as little as you want each year. There's no required minimum distribution for a Roth IRA.
Okay, perfect. All right, well, that was all the questions. I just wanted to put it out there that we are, well, I guess we have one more question. What is the deadline for deposits? April 15th, like an IRA?
Right, great question. With traditional and Roth IRAs, you have until April 15th, and that's because you know what your contribution limits are. I mean, it's basically $5,500 or $6,500. With a SEP IRA or a 401k, since they're employer-sponsored plans and some of the contributions are coming from an employer, you actually have until you file your taxes, so including extensions. So with a SEP IRA, because it's based on 25% of your income, you may not know what your income is until April the 14th when you're doing your taxes. So with an employer-sponsored plan, you actually, the contribution deadlines are October 15th. But if it's a traditional or Roth, it's April 15th.
Okay, and I do have another. Oh, sorry, go ahead.
I see it here. There's another question. When it comes to purchasing stocks, is there a limit to how often you can buy or sell? No, we don't actually offer stocks. Those are publicly traded securities. So typically clients would be at Schwab or Fidelity, and I don't believe there's any limitations on those. I'm sure there's day traders that trade those all the time. But we primarily deal with your non-traditional investments, the investments that you cannot buy through your Schwabs or Fidelities.
Okay. Well, all right. I just wanted to say that's all for questions right now. If you have any other ones, you can reach out to Brandon directly. But we are running a special promotion. If you open an IRA today or tomorrow, we're going to give you 50% off your new account setup fee. So just mention this webinar and you'll get 50% off. So you have to open it today or tomorrow. All right. I did. Sorry.
That fee is normally $50, so it's $25 on this promotion.
Yeah, so for $25 you can open up an IRA today or tomorrow. All right, I did put the handout, the PowerPoint slide in the handout section of the webinar program, as well as a guide about self-directed IRAs. If anyone needs anything else or has any questions, please feel free to reach out to myself or Brandon Hall. Thank you so much, Brandon. You did a great job.
Thank you, and thanks to everyone for attending. It was a good turnout, and I hope to do more of these and hope it was beneficial to you. All right. Have a great day, everyone.
Thank you.